How's it going, everyone? Welcome to the sweep. We're going to get started here in just a few seconds. Feel free to chat in, say hello, ask your questions. At some point within the session, we'll get your questions answered, so feel free to chat those in. All right, let's get going. Like, share, and follow on social media. We're getting some traction on Rumble, ironically. I'm not really sure how Rumble works quite yet, but we're starting to get some traction on Rumble, so that's kind of cool. So check us out on rumble.com, daytradesmart, /daytradesmart, and here are other social links. So let's go through our news. And thank you guys for the feedback on this. I appreciate that it's helping, and you guys giving us feedback on what you like to see, what you don't like to see, what things you'd like to, have us go through, things like that really helps, put these together. So your feedback is always appreciated. If there's things you don't like, let us know. If there's things you enjoy and want to see more of, let us know. If there's things you haven't seen that you'd like to see, let us know, and we'll be more than happy to accommodate. All right, so this is Saturday, nothing on the roster for Saturday. Sunday, we've got just some low-impact announcements for the Aussie and NZD, and Monday, which is a holiday, right, for the U.S. and the CAD, our banks are on holiday, but the rest of the market is still moving. The U.S. dollar is still going to be moving on Monday and trading. So, the market's not going to be closed. The market will still be open on Monday. And we've got 10:30 p.m. for the Aussie RBA rate statement. So that is a high impact, and then cash rate, medium impact. So this is going to be kind of like our FOMC when we talk about interest rates. This is Aussie's version of that. So be aware of that if you guys are trading in the evenings, 10:30 p.m. Mountain, midnight 30 Eastern, and so that would actually put you into the next day, right? September 7th. We've got this is Tuesday, medium impact, MPC member Saunders speaks, ZEW economic sentiment, and German ZEW economic sentiment. So medium impact there. Those are early morning, 1:30 a.m. Mountain, 3:30 Eastern, and 3 Mountain, 5 Eastern a.m. So not too much there either. Wednesday, we've got the BOC rate statement. So that's Bank of Canada, IVPMI overnight rate, and JOLTS job openings. So those are some medium impact that you want to be aware of, and that high impact for the CAD, the Bank of Canada rate statement. And then right here, the GDP, this is going to make some waves, so be careful when trading. Monetary policy report hearing for the GBP, and the CAD has the BOC press conference, the Bank of Canada press conference. We've got some medium impact 10-year bond auction, and FOMC member Williams speaks. So busy morning on Wednesdays. So keep an eye out for that. Thursday, we've got early morning monetary policy statement for the euro and main refinance rate for the euro, and then ECB press conference and unemployment claims for the U.S. So keep an eye out for that one, and then this ECB press conference and monetary policy statement for the euro. And then the CAD at 10 a.m. Mountain, noon Eastern, Bank of Canada Governor Macklem speaks. So keep an eye out for those. Thursday could be a rough one as well. So watch out for these. Obviously, again, we always let you know that we don't want you to trade on these announcements. We want you to be aware of them so you can avoid trading during these announcements. Okay, so it brings us to Friday. Friday, 6:30 a.m. Mountain, 8:30 Eastern, employment change for the CAD and unemployment rate for the CAD, and then PPI month end for the U.S. dollar, and then core PPI month end for the U.S. dollar as well. That one is a medium. The PPI month end is going to be a high impact, so keep an eye out for that one. That would bring us into next Saturday, and that's the EcoFin meetings, and we're not going to cover that today. That'll be for next week, but just be aware of that. So that is our Forex news for the week. Again, we want to avoid these things. We don't want to be in the market 30 minutes prior to an announcement, and at least 30 minutes after an announcement. And if I were to make a recommendation, I would say wait for a 1-hour post. So if an announcement happened at 6, then wait till 7 and for that next hour to post, and then you can look at your indications, place your trades, whatever it is you do at that point. So that way you stay far away from any kind of volume volatility that is not predictable, right? It can do whatever it wants. There's nothing in the rules that say just because an announcement comes out a certain way. For example, if I click on this CAD announcement, it says that, well, let's look for one that has, right here. Actual greater than forecast is good for currency. So if the forecast, which there's not a forecast out yet, and there will be later, but if the forecast is X and the actual is greater than that forecast, then that's supposed to be good for the Canadian dollar, which means in theory it should strengthen the Canadian dollar. But there's no rule that says that it has to strengthen. It can go the other direction, and the large institutions will bank on that a lot of times. It's called selling the rumor. You can look it up. If they know traders are going to be buying, and enough traders are going to be buying at that time, then they're going to do the opposite, because it's a zero net game. It's a zero-sum game, right? So in order to buy, somebody has to be selling. In order to sell, somebody has to be buying, and at the same rate. So if I'm a big institution and I've got billions and trillions of dollars and I want to put in a big fat trade, then I need a whole bunch of people going the opposite direction. So what better time than during an announcement when all these sucker traders are trying to buy or sell based on how the announcement reported, and then the banks just have a heyday with it, right? They just do the opposite because there's no rule that says they can't. So that's why we stay away from that stuff, because there's no telling when that kind of stuff will happen. So we just stay completely away from that. All right, let's get into this. So what I want to cover today is a new setup. And then I also want to show you how I analyzed this setup, because I actually backtested this setup by hand. So the setup is, and we'll just look at the ones for today. The setup is really simple. We want for the, and this is actually a user recommendation. So this is one of our traders that had just noticed this and decided to backtest it. And I went ahead and just backtested it 100%. So he obviously backtested it just for the times that he trades. On the currency pair that he trades. And so what I did is I went on the Euro USD and I just backtested every single time that it happened from January 2016 to December 2020. Just every single time it occurred, I went through the golden ratio analysis on it. I collected the highs and lows, and I marked them down. I'll show you guys that data sheet here in a moment, and then kind of how I've been playing around with it just by hand. So let me show you the setup. What you want is for this thick orange line to be at a value of 50. Right? It's always going to be negative. So value of negative 50, 50.00000. Okay? And if it's pointed up, then we want the majors to be pointed up. And we want the thin line, the thin orange line, to also be pointed up and visibly be higher than the thick orange line. Okay, so let me show this to you guys. It might sound complicated right now, but it's actually really simple. So let's just go back. So I made this just so I can highlight where they are, but there's one piece that's missing in it, and that is the thin orange. So you can see this is giving me a green pylon because it's saying, yes, the thick orange is at 50. Majors are pointed up, and thin orange is pointed up, but what I want to see is the thin orange to be higher than the thick orange. So a good way to look at that is if this black box right here is up here above that orange box, then I know that that thin orange line is higher, just in case it's not very clearly visible. Or if the thick orange line is pointed down with a value of 50, and the thin orange line is pointed down lower, and the majors are pointed down, then we would look for a short. sell, okay? So for this, let's just look for a 10 and 10. Let's just use, and I'll show you guys the backtest data, but I'm just so we have a target. So a 10 pip stop loss, 10 pip take profit. So let's go back and look for another one. Nope. So you can see that the thick orange is down. It's at 50, but the thin orange is not lower than the thick orange. Majors are down. And again, that black box is above the orange one when we're pointed down. We want it above the orange one if it's pointed up, but if it's pointed down, then we want it below the orange box. Then that would kind of show us where that thin orange line is in comparison to the thick orange line. So in that instance, it's not, so that's not a setup. Let's go back. Okay, so here's one. So we've got the thick orange at 50 pointed up, thin orange pointed up. See that black box that's above the, because they're pointed up, right? But you can see visibly, thin orange is way up here, thick orange is down there. Majors are pointed up. So right here, this would be our entry for a long or buy trade. Right here, 118.377. So we'd go to 118.477. Right about there. And then our stop loss would be 118.277. 277. Okay, let's go forward. That looked like it went down 4.7 pips. It went up 11. Yeah, that's enough. That's more than enough. We've got micro pip spread on the Euro USD, so less than a pip. So if it went more than a pip above it, then that would have been a profitable trade. So that's totally fine. Yeah, and even if it didn't, the next candle drew down again, but then busted up. So that's fine. That would have been a successful trade. Okay, so let's go back and look for the next one. Okay, right here, so this one's not one either, right? Because look, thick orange is at 50. Thin orange is not above thick orange. Majors are pointed up, so we're missing this one thing, the thin orange. So we're going to skip that one. And believe me, I tried it both ways. I tried it, well, what if we just, because sometimes they work out just fine, right? Like that one would have been okay, right? That's 11 pips. That's 1.3 drawdown. So it's not about whether or not that trade worked out, right? I want to be clear about this. It's not about whether or not this one trade worked out or even a handful of them worked out. It's about if it's consistent long term. And what I found in backtesting it myself is that he's onto something. That line being above the thick orange line when it's up, or below the thick orange line when it's down, like lower or higher, right, makes the difference in consistency. It's bizarre, but hats off to the kid for seeing that, right? So this would not count. We would not count that as the setup. All right, so let's go to the next. Okay, so this one does count, right? Because we've got thick orange at 50, thin orange above, right, visibly above thick orange, and majors pointed up. So right here, this would be our entry for a long or buy trade, right? So right there, 118.018, so 118.118. Holy cow, it's going to be way up there. 118.118. Make that blue. And then 117.918. Right there. So that's 10 and 10. That's a 1-to-1 risk to reward. That means that our risk is the same as our reward. So it's a 1-to-1, right? How many do we have? This is our second one, I think. Okay. Let's go forward. Nope. Not even close. You can tell it's low volume, right? It's a really low volume time. In that whole hour, that whole candle from top to bottom went 8 to 6 from that point to that point, right? And from its starting point, it went 4.7, 3.9. So it's not really moving very much. 2 hours. Look at that. That would be crummy. I don't like being in some of you guys don't mind it, but I don't like being in trades that long. There we go, 3. Okay. So probably just under 3 hours. It went 18.1, so we definitely would have gotten the 10 right there, and that one would have been just fine. Let's go back. Okay, right here we can see that the thick orange is at 50, and the thin orange, we see that black box, right, is below it, and majors are pointed down. So right there would be our entry for another short or sell trade. And our entry would be 117.961, so we'd go to 117.861. Right there. 861. And our stop loss will be 118.061. Oh, right there. Yes. Okay, so we want to go down to the blue line this time. Oh, it's going up. Went both directions a little bit. The first candle, right? Up 4.9, down about 5.1. Oh, that might be it. Hold on. 6 pips it went up and then came down 12.3. Yeah, so that's enough. That's good. All right, awesome. So let's try to pick up one more because I want to show you guys something. So let's just go back. So we're actually we only had 3 of these on the Euro USD at any given time, and we're in 8:30 right now and today's 9/3, so that's a good 3 days, 3 solid days, right? 3-4 days. Now we're in 8:27, so let's see, we got one here. Yep. So this is what I'm talking about. See how it's hard to tell where the thin orange is, but I can see this box is above the orange. So that right there would count, right? 50, thin orange is above thick orange, majors are pointed up. So there's the setup. So right there, that would be a long trade, 117.892 to 992, 117.8 to 117.992. Obviously a more higher volume time, right? Because we can see these lines are a little closer together. So the candles are larger right here than what we were seeing a moment ago. Yeah, okay. Excuse me. And then 117.792. Make that line red. Okay. Let's see how this one plays out. Okay, both ways it went down 5.5, went up 8.3, so no take profit yet. There it is. That went up 11.3, that's enough. Good. All right. So any chance I get, I like breaking this down for you guys. So I'm going to take this opportunity right now. This is, and I like illustrating this because we talk to a lot of people that have traded before. We talk to a lot of people that have never traded, and it's interesting, the perception. And so I want you to ask yourself, what do you think a professional day trader needs in order to be successful? What do you think you need in order to be successful? Some people say, well, to win a lot of trades, so have a high win percentage, or to get a whole bunch of movement, to be able to call a whole bunch of movement, catch the bottom as it goes up or catch the top as it goes down, right? All these different things. There's all these different things that we have in our head as to what creates a successful trader, okay? Now, on Thursday, which is September 9th, I am doing a webinar that I've done for my mastermind members. These are paid mastermind members, so they're going through coaching, or they've been through coaching. They spent thousands of dollars already, and I did 4-part series with them over 4 weeks. Okay, and I'm going to show this to you guys. I'm going to show you this 4-part. I'm going to teach it to you guys. On Thursday, September 9th, we're going to do it on Webinar Jam. So if you guys want to register for that, I'll provide a link in the description of this video after this session so that you guys can register for that webinar. All right, it's going to be Thursday, September 9th, starting at 6 p.m. Mountain, 8 p.m. Eastern, okay, and it's going to be about a 2-hour session. So join us for that, engage in it, especially the skeptics. If you know somebody, listen, I need a challenge, guys. I'm serious about this. I need a challenge, okay? If you know someone that's skeptical about day trading, okay, you've got your uncle George that, you know, spent his life on his mother's couch, on your grandmother's couch his whole life, but he's got an opinion about everything, and he thinks day trading is for suckers. Or you've got a super successful cousin or your father, your mother, or your grandfather, whoever, and they just think day trading is gambling. Or any kind of skeptic that you have in your life. I want you to bring them, and I want them to try to tear apart everything that I say and do. I want them to question everything. I want the hard questions. I want for you to bring the hard questions, and I want for somebody that you know that maybe you revere, respect, that you feel like can ask really hard questions as it pertains to day trading, bring them. I want those questions. I need a challenge. I want the hard questions. I don't want the slow pitch. I want the hard questions, okay? So bring those with you. Invite other people to bring them to that session. I want those questions, all right? So definitely join us for that. But I want you guys to understand this concept. If we were trading this trade, right? So we got 4 of them. We took 10 pips per trade. Let's just say that we had a $10,000 account. And we're trading 1%, okay, which would be $100, right? So that would be a lot size of 1.0, okay? That would be 1%, right? Because 1.0 is $10 per pip. $10 per pip 10 times is $100, right? And $100 is 1% of 10,000. So that's what we'd be risking. Now our risk to reward is the same. So when we lose $100. When we win $100. Okay? So we used the 1.0 lot size and we took 4 trades. So $100 per trade times 4 trades. Right? And that equals $400. Okay? Now, we didn't compound any of that. Obviously, the first trade, then our account would be $10,100, and then we would risk 1% of $10,100, and then the next trade would be $10,110 or $210, so on and so forth, right? So this is actually not looking at the fact that this number would actually be larger, okay? We're using a smaller, more conservative number and just looking at the straight across, as if we were just risking 1% of 10,000 on every trade and not counting our profit, okay? So if we were trading a max funded account, when we max fund our traders at $100,000, okay, $100,000. So what is 1% of $100,000? It's $1,000, right? This is $1,000. And we use a 10 lot because 10.0 lots is $100 per pip 10 times equals $1,000. $1,000 is 1% of 100,000. So it's still a 1% trade, right? Okay. And we did that 4 times. So that would equal $4,000. Okay. Here's the magic here, all right? If I took this trade, this $10,000 account, and I took this trade consistently, and let's just say it won 80% of the time, 70%, whatever it is, right? And, you know, sometimes my account looks like this, and other times it looks like this, right? And, you know, whatever, right? But I'm moving up into the right because I have a consistent win percentage. I have my stop loss and take profit. I've back tested it. Everything's working the way it should, right? Here's the cool part. I don't have to get more pips. I don't have to win at a higher win percentage. I don't have to risk more of my account. I don't have to do anything except for the same thing I did on that first trade, I can do on the 126th trade and the 1000th trade and so on and so forth. And every single time, as long as I stay committed to that and my account grows, then every single trade then becomes more and more and more valuable. So here I have a $10,000 account. I made $400 in that sequence. Here I have a $100,000 account. I made $4,000 in that sequence. Did I have to get more pips? No. Did I have to get a higher win percentage? No. Did I have to risk more of my account? No. Did I have to take more time out of my day to do it? No. It's very, very simple. Very simple. And I'm going to show you guys the 4 steps to becoming a 7-figure day trader on September 9th. Not today, so don't get too excited. I only have an hour today. But definitely attend that session, okay? Now, I want to show you guys. So I back tested this, and this is what I want you guys to see. I wanted to show you guys the setup and teach you guys the setup because I know you guys like that stuff, and I like teaching you guys new setups. But here's how it went. So if you go back on this chart, because this is the chart I used, right? And I'll go back to 2016. So it's 2015. Let's go. Okay, here we go. So here's 2016 right here. Okay, I'm in 1-4. So 2016 started on 1-3. That was the first trade day in 2016. So nothing there. So right here. Nope, that one doesn't count, right? The thin orange is above the thick orange. Right there, that one. 1-5 at 0-0. That was the first one I experienced. 1-5 at 0-0. Direction 1 means buy. Duration 25 minutes. So for 25 minutes, it drew down 3.6 pips and then came back to break even. And then after break even, it went 6.7 pips for 5 more minutes. So altogether, if you'd entered that trade at the end of that candle, it would have been 30 minutes, and it would have gone 3.6 pips against you for 25 minutes, and then 6.7 pips in your favor for 5 minutes. And then after that, overall, it went 17 pips against, right? So I put that there because in the event that I needed to see what it did after all of this, then I had that to reference, and I didn't have to go back to the trade. So let's look at that. How did that play out, right? So right here's a starting point, and we're going to go 6 candles. What did it do in 6 candles? 1, 2, 3, 4, 5, 6. There's 6 candles. Right there, there is 6.7 pips, right? And there is 10 pips. So how did I get the numbers that I got? Okay, so I'm going to mark that. I'm going to go back to that. And you can see my measurements right there. Let me get rid of them. Okay. So let me click forward. So that right there is 1 hour, right? So in that hour, in that first hour, that's where I had my peak profit. 6.7 pips right there. 6.7. So everything that happened before that point is drawdown. So right here, that's the lowest point. And that's 3.6. 20 and then 5 minutes to get back to break even. Right? So it went here, and then it came back to break even right there. And then right there, after that, right, so that's 25 minutes, and then 5 minutes later, it went to its peak. Right? So I've got that listed as 25 minutes for 3.6 pips, 6.7 pips peak profit for 5 minutes. And then we know what happened after that, right? Look, 2, 3, 4, 5, 6. After that, it would have drawn down 17 pips, right? So right there is, I marked that just in case I needed it, because after that fact, it went down. So I did that. Let's see, how many trades are in here? 2018, 2019, 2020. Right there, 12/31. 2020 was the last one I recorded. 636 trades. 636 trades. It says 637, but I have a header, right? So 636 trades occurred over that 5-year span, right? So now I've got all this data. So what do I do with it, right? Well, one thing that I would recommend if you did it this way, where I just collected every single time that it happened, so I didn't sequester it to specific trade times. every single time it happened, I recorded it, right? So I broke these down by trade sessions. Said, okay, 0 to 5:59, or 6 o'clock, 0 to 5, and that's 5:59, and then 6 to 11, and then 12 to 17, and 18 to 23 or whatever it is. So I broke it down to 4 different trade times, and these are UTC times, by the way. So here are the trade sessions. I've got, let's see, did I put them all in here? Yeah. So 0 to 5:59, right? There's that, and then 6 to 11, and then 12 to 17, and finally 18 to 23. So these are all sectioned off, right? So I have them separated because the Euro USD, and like we were just noticing, right, some parts of the day it moves bigger than other parts of the day, right? So today, for example, if I looked at today and I went to, let's say, the end of the day, from there to there, it moved 23 pips, right, over 3 hours. And I can go back and see that in one candle back here, it moved 43 pips. It took 3 hours to move 23, and in one candle, it moved 43. And the candle after that moved 28. That's one candle. And the candle after that moved 18, right? So, and then it started to slow down. 13, 8, 13, right? So you can see it's kind of slowed down after the high volume times. So if I were mixing in this trade session with this trade session, they would affect each other negatively, right? You wouldn't get a good output. So I broke it up between trade sessions. And those are the times that I broke it up by, right? Okay. So let's look at 0 to 5. So right here, 0 to 5, basically what I did is I went and I looked at drawdown, just drawdown, okay? So I took this, and I'm not done analyzing this, by the way. I'm still playing with it, but I wanted to have at least something for you guys today. So I'm going to sort this, right? So I just have drawdown. I'm going to sort it smallest to largest. I want everything to sort with it. Okay, now if I go to the bottom, then I can see that obviously I've got 164 trades, but if I go to the bottom, then I can kind of see where the drop off happens, right? And it's right about here. Look, so we go 11. Look at all these. We have quite a few 11s, only 3 actually, then a bunch of 10s, and then 9s, and so on and so forth. But right about there, it starts to really taper off. We got 112, 113, or a handful of 13s, and then 14. So it kind of gets into bigger numbers from there, right? I mean, really the biggest drop off is right here, 26 to 31, and then 31 to 36, then 37, then 39, and then all the way to 71 and 80, right? So I don't want to use those, right? But if I can see right here that there's a drop off, then I'm going to try to play around with that. Okay, what if I had a 12 pip stop loss? So that means everything below this point is a loss, right? Because that 12 happened before anything. It doesn't matter if this number right here is 560. It doesn't matter. If 12 pips happen first, then that's the drawdown. So if I say I want to limit it to 12 pips of drawdown, 12 pips of stop loss, then everything at 12 and below would be a loser, right? Because that happened before anything here, okay? So if it's 12, then I want to see, okay, what can I get if I had a 12 pip stop loss? What can I get? Can I get 6 pips? Can I get 9? Can I get 12, right? I want to look at that. Now, by the way, if I looked at this number, so I have 164 trades, and right there, 26 of them would be losers if I looked at just those. Obviously, you would have more than that, right? But so 164 trades total, and then 26 of them would be losers, 26. So this number would be winners, that minus that, and then this would be that divided by that times 100. So that would be about 16% of the whole, right? 16%, which would mean if these were the only losers we'd have, then we would have an 84% win rate, right? But that's just looking at everything that's 12 or more, right? That if I have an 84% win rate, then I would need no more than a 3-to-1 risk to reward, right? So my take profit would have to be 3 times my stop loss or less. Okay? So now I have a range in where I can look for my take profit, right? If my stop loss is 12, then the smallest take profit I can have is 4. I would have to have a take profit of at least 4, okay? Now, not only that, but I would have to have plus spread. So let's say right there 4.5, so we need at least 4.3. So let's use that 4.5 right there. And let's say these would be losers as well. And you can see most of them are already marked as losers. Okay? So if I had a 4 pip stop or a 12 pip stop loss and a 4 pip take profit, that's a 3-to-1 risk to reward. Okay? So right here I would have all of my trades that were below 4 pips, 4.5 pips, accounted for, and they're already losers, right? So, and this one is a loser, that one's a loser. This 5 pip is a loser because it drew down 14.5 pips. Actually, that might have even been a winner. So, yeah, because we're only looking for 4, and it went 5 before it went 14.5. Yeah, so that would be a winner. Okay, so it looks like I would actually have more winners that are not accounted for yet, right? This one would be a winner. Let's see. That one would not. So it's 2 more winners. That would not. That would not. So everything else is good. Yep. Yep. Okay, so I'd have 2 additional winners out of that. Yep. Actually, this would be a winner, 3, because you can see overall it went 26.3 drawdown, 10.6, but in the first 2 minutes it went 5.7 pips in favor with half a pip of drawdown. So that would be a winner because it would have gone 4 pips before anything else, before any of this happened. But this is out of 6 candles. This is in the first 2 minutes. That's why I mark that kind of stuff. That's why I list that, because I can use that. So that's 3 more winners. Let's see if we have any other ones. I'm just going to scrub this real quick. No. No. I think that's going to be all of them. Okay. So I got 3 more winners, which right here would mean, right here, I would have, let's see, 26. All those were accounted for. Actually, we would be good. We'd be good with what we have because everything was accounted for. Okay. So that would be we'd have an 84% win rate. Okay. So let's do it this way. Let's say, let's get rid of that and go equals that divided by that times 100. Okay, there we go, 84. 84%, right? So this is the total trades. This is what we lost. This is what we won. And this is our win percentage, okay? So you can see we didn't say, can I get a 4 pip take profit within a 12 pip stop loss? No, we said let's collect the information and analyze it and see what it tells us we can get. Now this looks okay, right? But this is also 3-to-1. So this right here equals that, the loss, times 12 pips. Or times 12. 26 winners at 12 pips. That's 312 loss. Equals that times 4. because every time we won one trade, we won 4 pips for 138 trades, right? And that would be 552 equals that minus that, and we have 240 net pips. Okay, 240 net pips out of that sequence right there. Okay, now we can see that that would have been likely our most profitable outcome, and that's just scratching the surface. We haven't looked at what if we positioned with post-trade movement or duration. We haven't looked at any of that. We haven't looked at buys versus sells, none of that. Now, I did some of that just so I can show you guys some of the numbers and different ways we can analyze this. So let's look at this one, for example. This is a 12-pip stop loss with a 5-pip take profit, okay? And this one won 72% of the time, okay? 72% of the time with a 12-pip stop loss and a 5-pip take profit. You can see that times 5, that times 12, and those would be, and then 38 would be the net pip. 38 pips out of all those trades, okay? So 38 pips is what you would have taken away from that out of all those trades. Now, right here we have a 12-pip stop loss and a 5-pip take profit, but what we determined is 3 o'clock and 4 o'clock are actually low-hanging fruit. So if we said we'll take all the trades except for the ones at 3 o'clock and 4 o'clock, then we have a total of 138 trades. 101 of them won, so there's our net pip, 505 pips. 37 of them lost for 444, and now we went from 38 pips net to 61. We almost doubled. All we did was removed trades, because we saw, and I'll show you how I came to that, 3 and 4 o'clock were low-hanging fruit. They didn't perform very well, right? So now we got an even better trade right here. So here's what we saw. At the 0 hour, right, the midnight hour, we had 43 trades, 31 of them win and 12 lose for 72%. At the 0100 hour UTC, we had a 71%. 0200 we had an 82%. 0300 is 69%. 0400 is 62%. And 0500 is 71%. So if we took all of those, then we would have had a 72% trade right there. And with that stop loss and take profit, we would have walked away with 38 pips. Now, obviously, depending on your lot size would determine how much that's worth, but you would have been profitable, but not by much. Now, if we removed these 69 and 62 percenters, then we actually ended up increasing our win percentage by 1%, right? That's it, 73%. But overall, eliminating those winners and losers, because it's at a 2-to-1, 2.5 to 1, eliminating those losers caused for us to have more net pips, 61 net pips. Okay? Now, if we looked at buys, if we only took buys, there was 102 buys and 62 sells. Out of 102 buys, 76 of them won, 26 of them lost for a 75% win rate. So that would have given us a net of 68 pips if we only took the buys. Okay? Now, if we only took the sells, we would have lost, because we had 62 total sells, 42 won, 20 lost, and we would have lost money. So our sells are losing, causing for us to lose. Our 3 and 4 o'clock are causing for us to lose. Okay? So if we took just buy only, straight across, we'd have that 75%, and we would have 68 net pips. Now, if we took buy only, and we did not trade at 0300 and 0400, we'd have 95 net pips. 95 net pips. So we went from 38 to digging a little deeper and seeing actually we can get 61, right? And then digging a little deeper and realizing, okay, we can get 68, and then digging a little deeper. This is not yellow. That is a percentage, not a net pip, 72%. So we got 68 right there. And then digging a little deeper, just a little deeper, right? And we realized Well, if we got rid of all the garbage, the low-hanging fruit, and the fact that sells actually lose more often than win, then we get rid of sells and we only take buys, and we only take buys when the setup happens at 0, 1, 2, and 5, then we have more net profit. So again, we're not just looking for a winner. How does this trade win? What parameters will win for us? We're looking for the best outcome. Not just a positive outcome, but the best outcome. So when I tell you guys, there is no better way to backtest than using the golden ratio analysis, right? There may be other methods in which people backtest, but it's not going to get you results like this. How do I know? Because we invented the golden ratio analysis. It didn't exist before we invented it. We invented the golden ratio analysis. We didn't invent backtesting, but just this analysis. And look at what we're able to do. We're able to continue to extrapolate. And again, right here, this is based on a 5-pip take profit and a 12-pip stop loss, right? But we saw straight across, if we looked at just straight across, 12-pip stop loss, 5-pip take profit, we have 38 net pips. But right here, we have a 4-pip take profit and a 12-pip stop loss. We win 84% of the time, and we have 240 net pips, right? Then if we took this and figured out if the buys and the sells and the wins and the losses like we did with these other ones, this number right here would be significantly larger, right? So we could see that we're actually not even where we need to be with this. Because what if we said, what if we only take buys and we only took them at those at 0, 1, 2, and 5. We only took buys at 0, 1, 2, and 5. We would likely get more than just 240 net pips, right? So you can see that there's still more that we can get out of this. Now here's the thing, is that we're not even done at that point. We could still take this information and say, okay, well, overall, what is the duration? On all these trades, what is the duration? How long does it take? Is there anything consistent with how long it takes to draw down and then come back to break even and then into profit, right? So we got a bunch of zeros and 2-minute and 10-minute, 5-minute. Let's see. So 19 is going to be 10%. How many do we have total again? Oh, no, 164. Okay, so 16 is going to be about 10%. So where's 16? Right there. That's 0, so no help there. What about 32? So about 20% of them. Let's see. Actually, we should go from the bottom. Let's go from the bottom. So 32, 240. Okay, let's see what gives us up here. 32. So about 20% of them, nothing there. So 80% of them, look at this. 80% of these trades, right? Actually, if we went, because 10% is going to be all zeros, right? So 90% of them, you can see right there, 10% of them, duration doesn't even matter because they're still 0. But as we get closer to 20%, right, which would be about 32 trades, give or take, we can see that over 80% of these trades draw down for 5 minutes. Over 80% of these trades draw down for 5 minutes. So if we just waited 5 minutes and then entered the trade, right? Or 2 minutes and then entered the trade as it's at its peak drawdown, right? 2-3 minutes and then entered the trade, then we could very well get in at a more optimal time 80% of the time. 80+% of the time. That's what the data is telling us, right? And then if we look at our post-trade movement duration, how long it takes to go back to break even after drawdown and then into its peak profit, then we can see that the post-trade movement duration, these are zeros, so because the post-trade movement was 0. So let's go further down. let's say right here, 5. We could take all this win-loss, right? So we can see this trade actually performs much better the longer it stays in. Because look, this is early on, 5 minutes, 10 minutes, 15, 30 minutes, still a lot of red and, mixed in with the white. And then as we get further and further down, 90 minutes, 110, we start seeing less red, more white, right? So this is a longer term trade, is our, at least for this time, right? The 0 to 6 UTC. So we can see that our post-trade movement duration is probably not going to do us any good. It's not going to help us because we want to see if it stays in longer, does it have less? Is it less likely to succeed, right? Because we can't say, well, if it stays in shorter, then it's less likely to succeed because there's nothing we can do about that. It's not like we can pull the trade because it's been in there a short amount of time because it still has the option to be in there for a long amount of time, right? So this is the part that matters. If it stays in longer, do we see more losers? And the answer is no. If it stays in longer, we see more winners. So we don't use PTMD. We don't use post-trade movement duration because it doesn't benefit us for this specific time, 0 to 5, right? But the drawdown duration does help us. We can see that if we wait 2 to 3 minutes when the trade happens at this time, that we could likely 80+% of the time position ourselves. So let's test that theory. Let's look at the 4 examples that we had, just the 4 most recent examples, right? So let's look at this one. No, that's not one. Don't look at that one. Close your eyes. That's not one either. Keep your eyes closed. Right here, okay. So you can open your eyes now. All right, so right here, let's look at let's look at it in 1 minute increments. So let's move this to a 1 minute chart, okay? Come on, load up. Okay, so let's look at our 1 minute chart. And this is 12. Ironically, this is, oh, no, it's not. I was going to say we'd have to find one that happened within, so let's just look, because we want 0 to 6. This is 12, so we got to go 0 to 6. That's 1, and that's at 0. Okay, here we go. So 0, this is the 0, and let's see, 1 minute. So we're looking for a buy, right? So that's 1 minute. It went against us. 2 minutes. Let's see what it does in 5 minutes. 3, 4, 5. So that matches, right? Because we said when we saw it, we saw that 5 minutes it draws down and comes back to break even. But we want to catch it when it draws down, not when it already comes back. So if we said just draw down 2 minutes, let's say 2 minutes, then right there we positioned 2.4 pips on a trade that we are taking 5 pips on. Half of our trade we have positioned in 2 minutes. And we only knew to do that because we backtested and collected that information, right? So now we're in the trade here. We draw down to there, 1.6 pips. And then we're out of the trade. That's 5 pips. 5.2 right there. 28 minutes from where we entered. Right? So it's pretty good. And I mean, not like it drew down very much, but we can see that definitely benefited us. Right? So consider trades that could very well have lost. So let's go to 0. Let's look at one of these losers. So order 144. Should be that one right there, or 144. Oh, I think I got the order different. That's why. Okay. So what is this is 5, 180, 19.7. Okay. And right here, 11.4 at 16, 11.4, 16 at 5. Okay. At 2, 3, 4, 5, right there. Okay. So let's look at a 1 minute. See if that would have benefited us. Wait 2 minutes. We're looking for a sell. 1, 2. So that's 2 minutes, right? And that moved up 2.4. So I'm not sure if it's going to benefit us very much in this case. 4, 5. Let's see if we waited 5 minutes, 4.8. So let's stick to the 2 minute. So there's 2 minutes. And then from there, was there any chance of getting 5 after that point before we went 12 against? 6.8. 12.5. Yeah, no help. Really didn't help us. But there could be situations where it does jack up on us and then come back, within 1 to 2 minutes. And we see that often, right? Just depending on what time of day we're trading. Or it pulls up, 7 or 8 pips, in the first couple minutes, and then comes back down that same, 7 or 8 pips, and that would have been your take profit before continuing and going up, multiple pips. So waiting that little bit, even if it's just 2 minutes, could make all the difference, even if it's just on a handful of trades, right? Even if it's just on a handful of trades. And in instances where it moves in your favor within those 2 minutes, then you can easily just subtract that take profit. I would just leave it and then just play it out. But you could either not take the trade if it doesn't position, or just wait a couple minutes and then enter at that point, right? That's what the data is telling us, right? And you could go back and kind of spot check that, or even go forward with your new parameters and check 2021, right? Because you backtested to 2020, so you can go 2021 and look at 2021 and see, okay, how does that play out, right? So if we went to 2021, and let's see if we can find one real quick, 0 to 6. That is one right there. Okay. So would it have benefited us to wait a couple minutes before selling on this one? 1, 2, a little bit, half a pip, not much, right? That went up. Let's see. That went 10.7, so that would not have stopped out yet. That would have done it. 12.9. Let's look for one more. Let's see. That's 2200. That is 0100, so that's within our time. That's not a setup though. That is not one either. Let's see right there. That's one, and that's at 1500, not at the correct time. Okay, well, I'm not going to take too much time with that. But you guys can go back and play with that, right? Look at your backtest data, look at the duration, look at the drawdown. But again, we've only scratched the surface, right? And we already have numerous working theories that are profitable. We've got just buys. We've got buys with and not taking 3 and 4 o'clock. We've got buy and sell that's profitable. We have buy and sell and not 3 at 4 o'clock. That's also profitable. So we have a ton of things in here that can work, and we still haven't even looked at everything else to determine if we do have the most profitable parameters right here, for example, with this 84%er, right? So there's still other places we can look to see how we can most maximize this particular setup to make as much profit as possible on it. So plenty of room to grow there, plenty of things to do, but that's what comes after backtesting, is being able to analyze it, playing with the data, and determining what the best parameters are for your trade setup, and then having the confidence to go forward with it. And again, on Thursday, we're going to talk a lot about that whole process, so you definitely want to join us for that. And just as always, I want to give you guys this offer like we always do, our Trader Lite promotion right now, $10. You're going to get access to some of this stuff. Matter of fact, if you guys are on this session today, I'm going to throw this out today and only today. Sign up for the Trader Lite today, and I'll know if you don't sign up today. But if you do sign up today, then I will give you the backtest videos for the golden ratio analysis and the how to collect the golden ratio analysis, and also how to analyze it, step-by-step instructions. So sign up for Trader Lite. Go to daytradesmart.com/free. That $10 will be donated to Feeding America. So that is still our charity partner. So definitely jump onto that. Take advantage of that extra content that I'll be throwing in addition to the proprietary indicators that you're going to have access to, the on-demand training videos, the continued education webinars and daily trading webinars, the trader chat, real-time alerts, and 2 one-on-one coaching sessions. So definitely jump on that today, and we will reward you with those additional content. So until next week, we appreciate you guys joining us, and we look forward to talking with you then. Have a good one.